From the Hill Country in Texas, this is OneRadioNetwork.com.
For some reason, I knew that. I don't know. I woke up this morning and I just knew it was OneRadioNetwork.com. Good morning. It's just a few minutes after 10 o'clock, just a bit late here. We are working on a couple of technical things, but we got it all straightened out. My nose itches. That means it always happens when I go in the air. And my name is Patrick Timpone. It is May, is it the 5th? Yeah, 4th. May 4th, 2022. And you've got OneRadioNetwork.com. Our 800 number is working. It's actually a 888 Dealy, 888-663-6386. Email Patrick at OneRadioNetwork.com. After our show here with Fred Dashevsky, we're going to just take a quick break and go to the little boys' room. And then we're going to come back and talk about some things going on in the world for our second show this morning. It'll be You and I, baby. Fred Dashevsky is here. Fred's a good friend, and I've known him for a very long time. He's the former partner of Andrew Goss when the company was SDL Incorporated. And Andrew, as you probably know, was a weekly guest here since 2008, and before that on KLBJ Radio with the Real World of Money show. And Andrew left us about 3 years ago. Rascal, he just decided to leave the Earth plane, and so Fred regrouped his company. It is now called U.S. Coin Capital, and they're in. You're still up there in North Carolina, though, right, Freddie? Good morning. Yeah. Well, let me turn on your microphone. Yeah, it's still South Carolina, right? South Carolina.
Hilton Head Island.
Well, Fred, good morning to you.
South of the border.
South of the border, come Mexico way. Good to have you here, and your company is U.S. Coin Capital at 800-878-2646. And Fred's here on the first Wednesday, of each month, and that would be today, May 4th. Well, the Federal Reserve Board is going to be meeting in, an hour or two?
Yeah, before 2 o'clock, they should be making their formal announcement, and this is probably going to be one of the more important announcements coming out of the Fed. Everybody, when I say everybody, I talk about the Wall Street mindset. So These are the traders, the guys who are taking positions on a regular daily basis and, watching the economy and, the guys who pretty much manage most of what happens within the stock market and the bond market and the daily economic markets. Mm-hmm. They all have pretty much factored in that the Fed will raise rates a half a point today. I would think that is going to be the case. I would say 95% certain that's what's going to happen. I think if they don't do that, either going higher or lower, it's going to come quite as a surprise. Everybody, again, they really have factored this in. So, they've calculated this as already having happened. They've adjusted accordingly. So this is the broad expectation. But there is a bigger looming issue.
Yeah, we'll talk about
it. And that is the Fed. It has to also announce what it's going to do about tapering its balance sheet.
Yeah. And we're going to explain to people what this all means and how it can affect the mortgage rates if they want to buy a home or, saving in the value of the dollar and all the things that are important to our listeners, right? Because this other stuff's kind of geeky, but you're smart enough, you can explain to us how it falls back. You follow the bouncing ball. So the Fed is going to raise interest rates for the federal funds rate from, a half a point to a full point. And that's the first time they've doing it, Fred, this big since 2008, right? Since 2008?
Yeah, this is the big change. So, for the past few years, we've had a prevailing market environment of lowering or interest rates remaining steadily near zero. And the whole intention of that was the Fed's effort to fight against the forces of a slowdown in the economy, which they laid the blame mostly on COVID. And let's accept that for the moment. So at least the last 2 years have been, directly caused by economic slowdowns having to do with COVID. Right. So, the economy had slowed, and the Fed had stepped in, making dramatic efforts to try to move the economy forward, keeping rates low, near zero, and also building its own balance sheet. And it has had a huge impact on the economy. A lot of it is going to be carrying forward for many, many years, maybe as long as 10 years from now. Really? We'll still be feeling the after effects, as we still are from people almost forget after 2008, we had massive economic changes created by actions of the Federal Reserve and the government that we're still feeling the impact of. And here it is, it's 2022. And what we've done in the past 2 years has actually been much larger than what was done in 2008. So if we're in 2022 still dealing with problems left over from 2008,
wow.
How far out is it going to go before we feel the final effects of what we've done in the last 2 years?
So you're alluding to the idea in the last couple of years, the amount of money that the Fed printed and then lent or bought stuff has just been phenomenal, right? Huge. 2 years.
Unprecedented. Nothing ever seen like it in U.S. history. So, the Fed bought an awful lot of debt from the U.S. government and put money into the economy in 2008. When it was done, it had over $4 trillion on its balance sheet, and that was comprised of a balance of bonds from the U.S. Treasury and a combination of mortgage-backed security documents that the Fed had purchased from various investment interests. So with that $4.5 trillion on its balance sheet, at one point in 2012, the Fed made its first effort to do a little unwinding, which was disastrous. They try to slow down their purchases and push back some of what they had accumulated. The knee-jerk reaction from the bond market and the stock market was so horrific, they had to stop doing it. And this was before any of the current economic problems kicked in. When COVID happened, the Fed went back to this policy of trying to buy debt from the government to help the economy move forward, and ended up buying so much that 4.4 trillion ended up being something over 9 trillion by the time they were done, which is where we sit now. And now the Fed's going to attempt to try to rapidly unwind this. And I think that is a bad decision, a dangerous decision, and I don't see how it's really going to work.
Yeah. So I'm looking at the balance sheet right now, Freddie, and it's from 3 or 4 days ago, but we're looking at U.S. Treasury securities, 5.7 trillion. So almost 6 trillion in debt, right, that we, the people, owe the Fed. So
and that's just the Treasury securities.
And so what else do we get? Yeah, that's just that. Their balance sheet is 8.9. So let's call it 9 trillion, right? $9 trillion. So that's what they're talking about, is raising the interest rates. Now, the interest rates that they're going to raise today, Fred, this is the amount of money that the banks will pay the Fed to loan them money, correct? And that's what it affects mortgages and stock market and everything else, right?
Yes, it filters right down through. If you see what's happened to that 30-year bond rate, the 10-year note is the key indicator for most people. It was paying 1.4% 2 years ago. So if you bought that 10-year Treasury from the U.S. government, you would be given an interest payment of 1.4%. It is currently pushing 3%.
Whoa.
So we've had that much of an increase already. And now the Fed is going to try to raise rates a little bit more. Again, it really needs to do this to slow down the inflation beast that it has let out of the cage.
But do you think that's going to work?
It's created a big problem.
Is that going to work? Because there's so many bloggers out there saying, they can raise rates all they want. And it's not going to, it can't get rid of all the money that they created, right? I mean, really?
What it can do is it can slow down the movement of the money, right? They can't reabsorb it. The only way to do that is for the Fed to do what it's talking about, which is unwinding its balance sheet, which is sort of the reverse of them pushing money into the economy by buying bonds. They want to now become a net seller. So they want to sell the bonds that they've accumulated off their balance sheet, effectively cash them in.
Oh, so suck money out of the economy, suck money out.
Exactly.
Right. So they can suck, in theory, they sell everything. They could suck 9 trillion out because somebody's going to give them 9 trillion for the paper they have, right?
Sure. The only problem with that is that you have to find somebody to buy that debt.
I know. Well, that's always a problem.
So herein lies the funky problem. The Fed had to purchase a tremendous amount of debt as the government was pushing more debt into the open market because it needed money and it was trying to raise revenue.
The last 14
Whenever
years.
there's a shortfall,
the last 14
and there aren't enough buyers, the Fed steps in and makes those allocations. So it absorbs the unsold amount of debt that the government's selling on a regular monthly basis. So at this point, we always have unfunded amounts that the Fed steps in to purchase.
Right.
And what happens is that gets added then to the Fed's balance sheet.
Right.
So if the Fed is trying to sell, or the government, is trying to sell $6 billion worth of short-term bonds today, but only finds $4 billion worth of buyers, the Fed will write the $2 billion gap check, write it to the Treasury, end up with that extra money now on its balance sheet, and hopefully at some point look to unwind that. So while we face a problem where the government is looking to raise more money, in other words, it needs to continually sell debt every month, simultaneously the Fed is saying it's going to try to sell its debt off its balance sheet back into the market. My question is, what happens if there aren't sustainable buyers? If the Fed can't step in and buy it, who ends up trying to buy all of this debt the Fed is trying to pump back into the market?
Well, doesn't that just raise interest rates because you have to make it more attractive for people to buy it? And interest rates go to 10 or 15% like they did in 1980. It's the same game, right? I mean, isn't it?
We could see rates rise as a cost of that, or we could just see simply an uneventful sale. So, we have an auction and nobody shows up.
Well,
so it's unsuccessful.
What happens then?
The Fed is unable to do this. They're talking about trying to unwind $4 or $5 trillion, try to get back to where they were in 2010 or 2012. At $100 billion a month, it would still take them 4 years to do that. And that presumes that they could successfully sell $100 billion in treasuries to an open market every month going forward for the next 4 years, while simultaneously the U.S. government is still trying to raise its own revenue by selling current debt into the open market. I just don't see how this is going to work. At the same time, the Fed is trying to raise interest rates because it's trying to slow down the flow of capital. And while it did its quantitative easing, which was the buying of debt, that was pushing money into the economy, it's now looking to do quantitative tightening, which is, again, trying to bleed off all of this massive amount on its accounting balances, push that back into the market. And I just don't see how this is going to function without a lot of market interruptions.
But if it would raise the 10 and 30-year interest that they'll pay people to up to 10 or 15 like it did in 1980, wouldn't that make it so attractive that they could sell this stuff?
That'll make the new debt more attractive. Absolutely. So if you were buying debt now and you had an option to buy something from the Fed that paid less or a new bond that paid more, you're likely to want the new bond. You're going to want the
new stuff.
Instrument.
So
you want the new stuff.
So let me see if I understand. So we've got $6 trillion in Treasury debt on the Fed's balance sheet. So they sell that at the current rate that they're paying the Treasury?
They're selling that at whatever it was paying when
that's
they purchased
it. Yeah, that's what I mean. So it could be 2 or 3%. Who's going to buy that?
Well, that's the problem. Again, they're running into their own roadblock.
That's what you're saying. Why would you buy that if they know that the new Treasury debt that the Treasury is going to make is going to keep going up, right? Why would you buy 2%? Yeah.
The only rationale is that there's volume of it available. So, the Fed will do what it can to try to push this stuff back into the market. And if it's unsuccessful in this effort, it could create volatility. Now, I had suggested, I think maybe on our last episode or the one before, that once the environment had changed from the Fed not lowering rates or keeping them at zero and reversing to now having rates go up, that it was going to change the way the stock market was going to function, because about 30% of the gains in the stock market over the past 2 years have come from one specific resource, and that was the ability of large corporations to borrow money at almost zero, use that money to purchase their own stock and drive the stock values higher.
Yes, sir.
Roughly 30% of the gains in the stock market in the past 2 years has directly been from that. Government issued debt coming into the open market, countries and other balance sheets adding to their balance sheets of debt instruments, but corporations using the availability of free money to buy their own stock. Driving the stock prices higher looks great for a while. It puts the CEOs into huge payment balances and bonuses. They were staggering last year. There were records of CEOs making bonus checks last year. Think about that. In an economy where everybody else is struggling, the CEOs were making more money than ever because the stock prices had gone up, but not because the company had grown, and not because the company had done anything different to raise additional capital or grown the size of their company. Instead, all they had done was utilize a financial trick, a gimmick. Borrow money at near zero, buy your own stock. If you can raise it for a half a point or a point, you've profited. And when you're talking about, billions, tens of billions, hundreds of billions of dollars, this is a very profitable vehicle.
Okay, let's go back to, say you have $6 trillion of treasuries at low interest rates that people don't really want because the Treasury is going to have to raise interest rates on what they pay so they can sell their stuff, right? So, and you said it's going to cause volatility. What does that mean, Fred, exactly? Can't the Fed just leave this stuff on their books if nobody wants to buy it? What's that? Why is that a problem? I don't understand that.
Well, okay. The problem is the Fed cannot end up indefinitely just simply being the last buyer of last resort and continually being the only person absorbing debt. At some point, we need support for government debt to come from a broader spectrum of the world. We need foreign countries to say, I'm willing to buy U.S. government debt.
Right.
We need individuals to buy U.S. government debt because, people tend to forget the government has a perpetual need for money. They're terrible about the fact that they're bleeding money constantly, and every month they come up with shortfalls because they're running deficits. So they can't bring in enough money through normal resources to cover their expenses. They have to sell debt in order to make up that gap, which is perfectly fine because most investors are usually willing to say, okay, I'm going to loan my government $100 million at today's interest rates, and I get paid interest rates on that money, and everybody's happy. So the government has the need fulfilled, I get interest on my money, and the functioning market continues to work. The problem is a lot of people are experiencing an inflationary interest rate issue, which is that we are in a negative yielding world. So what I mean by that is that the debt that's offered, the interest payments that are being offered that it's willing to pay are not high enough to cover the current rate of inflation.
Right.
So in reality, you buy $100 million worth of debt that pays 2% when the inflation rate is 8%, you're really giving up 6% a year of your money, and you understand that going into it. But sometimes that seems like a reasonable choice because the other option is to maybe, for example, invest in the stock market that now is becoming extremely volatile. I don't know if you've noticed, but the past month or so, the volatility index, they call it the VIX, V-I-X,
huge.
which is simply an assigned number to show how much volatility there is in the market. It had been a number that had run 8, 9, 10, 12 was pretty high. We've seen the volatility index go over 30 in the past couple months, numerous times, and the stock market every day is moving 400 points, 500 points, 800, up and down. So this volatility is coming from this new readjustment. So as the world is moving forward, companies are now reporting their current earnings for this new year. And what's happening is that people are reevaluating the stock value, saying, well, let's presume 30% of the value of your stock right now has simply come from you utilizing low interest rates to buy your own stock. So in other words, we already think your stock's a little bit overvalued, which means that when you report this quarter, it better be a hell of a quarter. It better be gangbusters, because otherwise, how do you justify this current stock value? And God forbid you come out with a corporate earnings report that is not spectacular. Well, you're going to get crushed in the current market. They're going to devalue your stock dramatically, and it's going to create huge sell-offs. And this is why we're getting these volatile swings in the market, as the companies no longer can make their stock just keep going up month after month by buying it. Now they have to actually drive the stock value higher by doing what they should be doing as a company, creating more earnings or growing their company in the real world.
And traders know this stuff. I mean, they're not, they may be drinking a lot of coffee and whatever, but they know this stuff, and this is what's going on. Fred Dashevsky is with us, and we are live here this morning on 4 May 2022. If you care to join us, our 800 line is working. You can ask Fred a question about your particular issue. 888-663-6386. Email Patrick, OneRadioNetwork.com. His company is U.S. Coin Capital, and he buys and sells gold coins for a living, as a little disclaimer. But and we'll tell you more about that and how you might be able to get some gold and silver stuff. So I saw where...
May the fourth be with you.
May the fourth be with you. So I saw where the GDP this last quarter was minus 1.4%. So, okay, so we're not producing anything. I mean, is this classic stagflation, inflation with no growth. This is what happened during the Jimmy Carter era, right?
Yes.
Pretty much?
This is the worst case scenario outside of a deep recession that we could experience. So when you have an inflationary economy, if the growth is happening simultaneously, the general economic understanding is that growth can absorb debt. It can absorb some of the problems. So if the company or the corporation or the country, even any way you look at that, is growing, then if it's adding more debt, some of that can be absorbed by that additional growth. But what happens when you have additional debt being piled on and you're getting no growth? No growth. Or worse, slowing growth. Now you have a real problem. You have money coming into the economy, expanding the supply of money, inflation growing, but there's no absorption possibility. There's no sponge to suck up all this additional capital. And that creates a huge problem for the Federal Reserve, because normally there is a way for them to deal with that. If we were in a regular economic environment and we were facing any form of stagflation, the Fed could simply say, okay, we know how to deal with this. We're going to drop interest rates and make them significantly lower, and that will help with the stagflation problem because it'll kickstart the growth part of the economy that isn't happening. We're not seeing growth in the economy, but we can make growth happen if we make interest rates lower. The problem, however, is that we've already done that. We've utilized that tool to its extent. We've gone so far as to drop rates to low, and we've gotten to zero. And when that wasn't sufficient, the Fed then instituted all of these cute little tricks like quantitative easing and everything that it did to continue to try to drive rates down, which it successfully did. But simultaneously, by doing all of those things, it opened a very large gate to a monster that had been hiding for 30 or 40 years, and that's the beast of inflation, which has now been released. It's out there and running amok. So everything from, groceries to gasoline are going up in price because the inflation we've created has been exorbitant, and now the inflation beast is loose. So the Fed now has to face a very unusual situation. It can't lower rates when it's trying to fight inflation, because the way you fight inflation is you raise rates. Raise rates, which is what they're going to do today, right? Yeah, half a point. Right. So if you're going to raise rates to fight inflation, you're not simultaneously going to be able to stimulate economic growth, which means you're basically accepting the notion that the Fed's going to create either stagflation or, believe it or not, the big money guys, they're all betting on recession. A recession, is that 2 quarters of negative growth, or is that a classic? 2 or 3 quarters of negative economic growth. So that word's being thrown around. So that's really pretty much what's going to happen. You keep raising rates, right, Fred? I'll tell you what, it's tough to say for certain, but it's going to be, in my opinion, either stagflation or recession. Now, again, the big money guys, and these are the biggest guys that are out there on Wall Street that have been around for decades. They've researched this stuff back to the 1940s. They've looked at every economic environment we've ever been through. They're betting on recession. They all are piling into this recession pool, saying they don't see any other possible outcome. I think we might get stagflation for a while, but a recession seems almost inevitable. And then the Fed has a new problem. Now what do you do? How do you raise rates and lower rates at the same time? What do traders do when they feel like recession is coming? Where do they put their money? Well, that's interesting. That's a good question, because that's the choice that they make on a daily basis now, which is why everybody is hanging. They're hanging on this Fed decision today. Is the Fed going to maintain what it said it's going to do? It has absolutely projected this out. There's no question that the Fed has said flat out what they're going to do today. Yeah. I mean, they have forecasted to the point where it's accepted already. It's as if it's already happened. Right. The bigger question is going to be, what do they say about how they're going to manage this balance sheet? I mean, if they're going to try to get aggressive about reducing the balance sheet, and I think there's a rationale for that, as odd as it would seem, it almost seems like, why would the Fed try to unwind its balance sheet in such a weird and uncertain and weak economy? The answer is I think it needs to leave itself room to go back to buying more debt from the federal government again in another cycle, because it may end up with no other choice but to try to stimulate economic activity again by coming back and being an aggressive bond buyer. So in order to be back in that position where they can do that, they've got to get rid of some of the stuff they've acquired over there. They just can't continue to add. I know we throw the numbers around,
It's a lot.
but we are talking about trillions of dollars on the Fed's balance sheet. It's not billions or hundreds of billions. It's trillions. And at $100 billion a month in bond sales, it's still going to take them 4 years to unwind this monstrous size balance sheet.
And meanwhile, then the Treasury is about $100 billion in the red every month, right? Pretty close, right? Trillion.
Well,
All right. Is that
again, whatever the government is deficit spending has to be dealt with on top of that.
Well, that's what I mean. Yeah.
It would be nice if we had a government that was, running a positive cash flow,
No way.
so that the Fed could do this in the open market and the economy could absorb the debt, and the government wasn't simultaneously looking for money. But the government is still looking for money on a monthly basis. It's having bond auctions every month.
Sure.
And some of it has still been unsubscribed. So it's still facing a big problem.
Yeah.
It can't find buyers at current levels, that's for sure. Not enough.
And then you add on to it this whole Ukraine thing, and you have Fauci out there and Bill Gates talking about new variants, right? I mean, they want to do something else. You watch these guys; they're not going to let up on controlling people, in my opinion. You got some real stupid stuff going on in the world of money.
As
right?
if there weren't enough,
As
right?
if there
We
weren't
have
enough.
a lot of crazy stuff going on.
That's right.
So Ukraine has added a number of problems.
Sure.
It has created another inflationary problem. It has created a little bit of a staggering slowdown of economic growth around the world. Obviously, we're pushing sanctions on Russia to try to prevent them from, a good flowing economy. This is how we're trying to punish them for what we deem as inappropriate behavior.
Right.
So, for example, Russia today had a scramble. It had to come up with $650 million today.
Oh, really?
In order to pay off bonds that it owned that were due, and it had to be paid in U.S. dollars. And they try to say, well, we'll pay it in rubles, and nobody would do it.
Nobody wanted the rubles.
No. The people that held their debt said, no, we want U.S. dollars. So Russia had a scramble to find its stockpile, which it had, of U.S. dollars, and use those U.S. dollars to pay off its debt. That it barely made it through today, and it's got more coming up in the next couple of weeks.
Wow.
So the sanctions, are creating problems for other people. So let's say, you were a regular, normal international investor, and you allowed Russia to hold U.S. Treasury bonds, and now they're due and they're paying you. You're saying, well, wait, I want to get paid in U.S. dollars. And Russia's saying, well, we don't have U.S. dollars. Will you take rubles? And you're saying no. So now the U.S. government is like, well, do we allow Russia to default on its debt, or do we give them access to more U.S. dollars, which we're trying to prevent them from having, to force them to have to use rubles and, to push sanctions on them. So this whole thing is spreading worldwide.
Just crazy.
As a much bigger problem than I think they might have figured initially, because I don't think they thought it through and recognized that the backwash might even affect allies of ours that are holding debt from Russia that are looking to try to get paid.
Yeah. Oh, you mean thought it through by not working a deal to not have NATO go into Ukraine, which started this thing in the first place? Is that what you're talking about? Yeah. Or the United States didn't. That's all. My sources say that's all Putin wanted, really. Just tell me you're not going to put NATO into Ukraine, and we're good. And they didn't want to do it. They didn't want to do it. So they pushed them into this, in my opinion. And now Europe is saying we're gonna ban Russian oil. Did you see that, into the EU? And they need it.
I'm sorry, I can barely hear you, Patrick.
You can barely hear me. Wait, can you hear me? Can you hear me?
Yeah. Can you turn up your volume a little bit?
I don't know what's going on. Hold on. So now we're seeing. Can you hear me now? Now you see? Huh?
That's a little better.
Is it a little better? I wonder why. I'm
still a little soft.
I'm
but
going,
I got you.
I'm going full blown. So the EU is saying that they want to ban Russian oil, but they need it. I don't know what's up with that. And there are many people that are paying rubles as Putin is demanding, right, for their oil and gas. So it's a real dance.
Well, Russia does have, they do have a wonderful ability to continue to raise capital because they do have oil reserves, right? And
gas.
That is one of the things that has saved them,
Right.
is their ability to sell oil to whoever they choose to at whatever price they choose to, because they do have a large supply, and that has enabled them to skirt some of the issues. But I think eventually these sanctions will begin to have enough of an impact that it's going to be a problem for them. They might be able to get away without it being too impactful for a while because they can raise more capital now by selling more oil. But, that also becomes its own problem. So they have to align people who want to buy Russian oil. And if we ally a group of countries to all say, we're not going to buy Russian oil, well, now you're cutting off their biggest resource of revenue. If everybody gets together, let's say every country, just imagine if every country said, we're not going to buy any Russian oil. Well, now Russia's screwed because now it cannot raise the revenue it's going to need. And now the sanctions that we're putting on it that won't allow it to play ball with the other investment banks around the world and not use U.S. dollars, that's going to have a much greater impact. As long as Russia could continue to sell oil, the sanction impacts are going to be a lot less impactful.
Well, they're selling it to China for yuan, and now he just got back from India and made a deal with Modi to sell them. I don't know, I think for rubles. So if he got India and China, he might have enough buyers to stay.
China's
right?
having a real economic slowdown, and that's also creating a big problem. They account for about 25% of the world's economic movement and economy as a whole. So as they slow down, as is happening in Europe and also the rest of Asia, it's been rather interesting because money has been piling into the U.S. dollar. We've talked about that dollar index.
Right.
Remember we had talked about it
today,
was like 93, and we were talking about, boy, if it strengthens to 93.5, 94, that was a sign that the U.S. dollar was really getting strong. Normally that pushed down the price of gold and silver because those things are mirror images. Well, the dollar index has skyrocketed. It went over 101 and it's climbing, and we're at a 20-year high for the dollar.
103 today.
And yet gold is still at 1860 an ounce.
Yeah, 103 today. 103.22 at this
103.
That's
okay.
Crazy.
So
yeah.
These are record highs for the U.S. dollar. I mean, more strength in the U.S. dollar than the last 20 years. And why is that? Is it because internally things are great in the U.S.? No. It's because, as the adage goes, the cleanest dirty shirt in the laundry. The U.S. dollar now looks attractive to worldwide investors because if China's slowing down and their economy is at zero, well, there's no point in having, Chinese yuan. If Japan and the rest of Asia is slowing down, you're not going to denominate value in yen. The ruble, is sane. The risk in a ruble right now, although it's held up because Russia's been able to sell oil.
Right.
I think most people around the world would deem the ruble as pretty risky. And where does that leave everybody? Well, we look back at U.S. and say, okay, $9 trillion on the Fed balance sheet, $32 trillion worth of national debt, an economy that's barely growing, if at all, and lots of problems on the horizon. But all in all, they look a little better than Europe, Asia, and everybody else. So pile into the U.S. dollar, and this is why the dollar is strengthening. What's amazing to me is as strong as the dollar has been, it should have driven gold prices through the floor.
Right.
And it has not been able to do that because no one's buying this. They're just simply reacting to the market on a short-term basis, but no one's forgetting the fact that the inflationary problem is looming in the background at a level that no one's seen. We have a whole generation of Americans that have never experienced inflation.
Really?
It's been 40 years since we've had
Yeah.
inflation at 8.5% or 9%. There's a whole generation that have never grown up with any inflationary problems. They've never seen prices go up at the grocery store. They've never had to pay, Jimmy Carter your money for oil and for gas for their car.
Yeah.
They're, those people who live in the Northeast that have oil burners that have to put a couple $1,000s worth of, oil in their tanks to fill up for the winter. they are going to be hurt by these increasing prices. And this is something a lot of people have not experienced, but anecdotally now, it's impossible not to see the inflation.
Yeah.
Even those people that don't pay attention to economics, you're experiencing it on a day-to-day basis. And because of that, a lot of people realize there is a flaw. There's something fundamentally wrong here in the U.S., and it's still driving capital into gold and silver, even with the dollar at a 20-year high.
So I don't know. If I was somebody who had a lot of money and with a lot of power and influence, I'd be just buying gold. I mean, there must be a demand for gold that's pretty.
Oh, it's huge.
It's huge right now?
Huge.
Yeah.
Silver and gold, it's been massive. In fact, if I were an investor right now sitting on capital
Boom.
that I'm looking at over the next 5 years, I would be stockpiling gold and silver right now. I would be loading heavily into that market right now, because I'm telling you, the dollar is going to experience a loss in purchasing power at such a vast and extensive level that we have not been used to for so long, that it's going to catch a lot of people by surprise. And those people that are thinking about retirement or have, again, large amounts of money that they've saved and earned over the years, its value is going to dissipate very quickly if they don't adjust. And a lot of people have figured this out. So there's massive demand going on across the board. Gold and silver coins have been incredible. The market environment has been, just super strong.
I bet.
The auctions that have been happening the past several months, the big coin shows that have been happening, it's just been monstrous. The activity is just over the top.
And this has been happening, as you say, without gold prices really going up a whole lot. They've been steady. As you've taught us, this is a controlled spot price, right? The gold fix and the silver.
Oh, sure.
It's not a free market. And if it was a free market, gold could be, $4,000 today or something. I don't know. But, and this is all happening with gold. So what would be the precipitate the gold and silver prices really starting to make some moves, which they would then, as you know, more people want to buy it when it's going up, which is kind of counterintuitive rather than...
Yeah. Well,
right.
The nice thing is that the value of gold and silver coins are continually climbing, even with the volatility in the price of gold and silver itself. The rare coin side of the market is still growing. But what will drive the price of gold higher is as people really begin to perceive the inflation. Again, there are going to be short-term things that will intervene in the price of gold's climb, which is why it looks like a ratchet. I meant to pull up a graph. I didn't do it. I don't know if you can, but you pull up a graph of gold, let's say over the last 10 years, or silver in the last 10 years, and you'll see a steady increase going from left to right. It is clearly on an upward climb, but what you'll notice is that it looks like a bunch of steps. It's not a straight line. It's a ratchet. It moves up, it pulls back, it moves up, it pulls back, it moves up a little higher, it pulls back, and it continues to do this little step climb. So periodically, there will be these pullbacks. I think they create great buying opportunities. Gold was almost $2,000 an ounce 2 weeks ago. And that was because people were recognizing the inflation problem. Then we had a little bit of a dollar rally and again, a pullback in gold. Nothing has changed from 2 weeks ago. So it's like, it's like a good basketball player faking his head to the left and moving right. It's a great head fake. And it will fool a lot of people to temporarily believe that, gold is not going up. But it is. And it's going to continue to get higher and higher. We had this same conversation when gold was running between 11 and 1,300 an ounce. It would get to 1,270. And then one day we're looking at 1,190. And people are like, well, why is gold down? Well, it is, but it's not. I mean, it's part of the nature and the way that gold climbs. It will never go straight up. When it got close to 2,000, there was an extensive effort to try to suppress the price, because the last thing that they want in the open world is for people to believe that the U.S. dollar is being so heavily inflated that they need to dump dollars and start buying gold and silver.
That's what they don't want.
Crypto or something else.
Yeah.
Because if we can't get people to continue wanting dollars, how are we as a government going to sell debt? And how is the Federal Reserve going to unwind its debt? If no one wants the dollar, how are you going to do that? It would be like trying to sell Russian bonds right now. How hard would that be? I would not want to be a Russian bond salesman in today's world.
No. A couple questions here. I'm looking at the chart, Fred, and boy, 2019, as you know, that's when it really took off, right, from 1,200 up to 2,100, right? Over 20 2019, 2020. What happened there? What was going on there? I mean, how come they couldn't keep it down from that move?
Well, again, this is where the quantitative easing and all this sort of nonsense was really starting to unwind and become a real big thing, where people began to see the extent, the effort that the Fed was making to try to solve the economic problem. And I think at that point, people were still feeling the panic of 2008. They remembered how close the economy had come to the brink, and they were terrified that if the Fed didn't pull this off, that we might have a complete economic disaster. And people were worried that the dollar was going to implode. And they were running from the dollar and buying gold and silver as fast as they could, driving prices higher and higher and higher. So you're going to get these periods where the psychology shifts. And to me, it's kind of interesting that, a market can be moved not based on fundamentals, but based on psychology. But a lot of what moves markets is perception. A lot of it is perception. And even when it comes to inflation, a lot of it is perception. That's why I think this is different in that it's hard to not see the inflation. It's one thing when you and I talk about it in a mechanism form. We can say, I saw the inflation in 2020. I recognized it then because what I saw was the money supply growing.
Right.
And I understand that you cannot increase the supply of money in a fixed economic environment without creating inflation. But there was no anecdotal notice of it there. It wasn't visible to people.
Yeah.
All we could see is you and I could look at the Federal Reserve's balance sheet. We could watch Fred, and we could see that, hey, this money supply is exploding. I know what that means in the end. But for most people, it doesn't translate.
Now they see
now
it.
What we have is a visible inflation market, right? You can't go anywhere without experiencing higher prices, which we know is the end result of pushing money into the economy. So right now, it's a lot more visible for people. So they're paying a lot more attention. But they do like it when the Fed says, well, we have this, idea. We have a plan. And here's our plan. We're gonna start raising rates, and that's going to help the inflationary problem. We're going to unwind our balance sheet, which will put us in a better position to address whatever economic issues come up in the future. And we're going to do all this simultaneously without trying to stall the economy. I say good luck.
Yeah. Well, Fred, no matter what these guys do up in Washington, D.C. and the New York Fed, I can't see how going to my HEB is going to change the price of fish that is like almost, some of this fish is doubled. And I don't even know, it must be some supply chain thing, It's like crazy.
Well, that's another part of the problem, right? So there are multiple things going on here. Not only do we have the loss of value in the money creating the inflation increase, but now again, on top of that, as if this weren't enough, we also have supply chain problems. So COVID created a problem of employment. So you literally didn't have enough people to move product from one place to another. And we had talked years ago about the tightness of the supply chain issue,
just in time,
and how ridiculously just-in-time ordering had gotten, where the entire world was running on this so tightly wound rope that there was simply no wiggle room. And as soon as there was a break in that supply chain, everything kind of fell apart and got backlogged. And on top of that, then we had shipping issues, and then we had container problems, and we had manpower problems at ports where you couldn't unload ships fast enough. And 100 ships off the coast of Long Beach lined up trying to unload product that's been sitting there for 3 months now. Things that used to take 2 or 3 weeks to come into the U.S. now take 2 or 3 months. Everything I order that comes overseas, they may immediately recognize that I've got an order placed, but within a couple of days, I always get one of these. Your order's been placed, but there is a back order.
You'd think.
We expect about a month delay.
Have you seen the amount of ships that are outside of Shanghai there, just trying to get in?
Insane.
And they're in China. I don't know what they're thinking. They're locking down people more because they claim there's more. I don't know. They're really locking people down.
You have a slowing economy in China, and you don't have enough labor to remove the products.
And they're locking
people
down.
And again, we import a lot of our stuff. Remember, America's pretty bad about one thing. We don't produce a lot of our own stuff. We buy everything from everybody.
Yeah.
The percentage of things that we take in from outside sources, of our day-to-day life is huge. Includes, everything from our food supplies to, chips and things like that for computers,
for cars,
parts for automobiles. everything that we do is coming from outside sources. With this supply chain niche, without it flowing smoothly, all these things being backlogged and delayed, it's adding to the inflationary problem. So it's forcing prices to go up because there's a squeeze on availability products. And, manufacturers are not dumb, neither are the retailers. If there's one camera or if there's one television available because they used to have 100 of them in stock,
they'll raise the price.
They're going to get what they want for it. There's no reason they can't raise their prices. And this isn't even accounting for the labor problem, right? So now as everybody is going around and working, and day-to-day people are experiencing higher prices, they're going back to their employers and saying, listen, I can't make ends meet on this salary. You need to bump up my pay. So now the employers have to pay out more money, pay more taxes on the money they're paying.
Which is inflationary.
Everything is becoming this sort of cycle. It's like a snowball effect. And again, while this is all happening, the Fed is trying to say, they're going to push back into the market $5 trillion worth of debt that they bought in the past 2 years.
I agree with you.
They don't think this is going to create a problem. I'm
not going to happen.
Bewildered.
And the trade deficit I saw this morning was over $100 billion. So we're buying, and that puts a squeeze on GDP, right? Gross domestic product. We're not. Say what you will about Trump, but he talked about this for years. He talked about this idea. We got to start making this stuff at home. And he tried. Yep. He tried.
No, I don't think he did that, understanding where we would be today. In other words, right, that was not his thought. But I think what had come to recognition by the time he had become president was that, we have moved away over the decades more and more towards being globalists. So we're trying to encourage worldwide trade. And that's all well and good. But little by little, we suddenly also did give away all of the products and manufacturing that we did, because it became substantially cheaper to set up a manufacturing plant in India or in Vietnam than it did in Ohio or Pennsylvania. So, if we're manufacturing products outside the U.S., then they have to be brought in here somehow. And if that supply chain gets interrupted, now we've created a bigger problem. And I think, Trump recognized that our, let's say, requirement to have things coming from outside the U.S. weakened the United States as a country. It made us more reliant on these countries. And he felt that we just shouldn't be so reliant on the rest of the world. We should more internalize the production of the things that we need. The more we could do that, the stronger we could be as a nation. And I don't think it was because he expected supply chain problems, but I think it was just a general idea that we'd gone too far. We'd gone from trying to encourage worldwide trade to becoming now reliant on everybody to provide us with all the things we need on a daily basis. I mean, nobody's going to forget how ridiculous toilet paper got for a while. I know. I mean, of all the strange things to happen, we are experiencing an unusual set of circumstances. But this is unprecedented territory where we are now. We've never had this kind of environment before. And I think the Fed has got to try to figure it out on the fly. And, I've researched this stuff back as far as the Fed goes. I mean, going back to when they were established, they have a horrible track record of trying to deal with economic environments that are in the uncertain range. They have a horrible track record of trying to deal with things that are bigger than they are. And they tend to be very far behind the curve. In this case, they are so far behind the curve. The raising of rates that we've talked about is starting now, should have started a year and a half ago. They should have been slowly letting rates rise, but they didn't. Now they have to try to do it more quickly, which means instead of, let's say, quarter point raises, they're going to have to be 50 basis point raises, maybe 75. And they're going to have to continue to do this month after month after month. And if they go too fast, that's what creates this recession. And this is why I think the big money guys are fairly certain that the end result of what we're going to experience, because of what the Fed's going to attempt to do to fight off inflation, is that the Fed's going to create a recessionary economy.
Fred, do you have an idea of what the foreign purchase of treasuries like China, Japan, Saudi Arabia, Ireland, and do we know what that number is about? Any idea?
Yeah, we know how much they hold.
Yeah.
I mean, I think the number was something like 12 trillion for China. It was a pretty good number, but somebody had done the math once and said, what if China gets upset with the U.S. and says, in order to fight back against, let's say, a Trump-style environment where we try to say we don't want to import any more goods from China, and we're going to stop doing that. We're going to try to do things more domestically. They said, well, what if China retaliates and tries to sell off its, U.S. debt?
Not 12 trillion, 1.2 trillion, not 12 trillion.
1.2 trillion.
Okay.
So if China tries to sell off half of what it has,
that'd be huge.
The problem is that it would drop the price of the bonds that it held by so much. The remaining bonds it didn't sell would go down in value so much simply by them selling half of what they held, that it would have negated the sale of the first half. They would have gained nothing.
Yeah.
They would have lost 50% of the value of the remaining half, and effectively nothing would have changed. So they can't really hurt us by trying to sell off. They don't hold enough to really damage the U.S. economy. But
couldn't they just, what if they woke up someday and had too much sake or whatever they drink and said, we're just going to sell the trillion out in the market? Wouldn't that hurt this country?
Well, sure, but again, it would hurt them as much as it would hurt us. So there's no real gain there. I mean, and it would hurt us temporarily. What I think would have to happen in such an extreme circumstance, which I think is
they're not going to do it.
It's unrealistic. There's no real benefit to them to do that. China thinks long term. They don't think about tomorrow. They think about 10 years, 20 years from now, 100 years from now. The Fed would step in and make that purchase if it had to.
Sure.
Recognizing that it's going to have to create a monstrous inflationary problem within the U.S. to pull that off, but that's what they would do. They wouldn't.
They would just buy it.
They wouldn't just let it go down. So
also,
we could absorb it.
You mentioned something earlier. Before we go, if you have a chance, if you'd like to talk to Fred, 888-663-6386. So people that bought a 10-year Treasury, you said 2 years ago, they are getting 1.4% interest, right, for 10 years, correct?
Yes.
Now, the 10-year Treasury is up to what?
It's up to 3%.
3%. So did those folks that own these 10-year Treasuries, they just lost a lot of money, right?
Well, it's an opportunity loss.
An opportunity loss, but if they just let it go to the end, it's not terrible. They just only get 1.4%.
They just get less money. But here's the problem. What if they don't want to hold it to fruition?
Which most people don't.
What if they wanted to sell that back into the market?
Then they lose.
The problem is that demand for those lower paying yields is going to be a lot less than the current ones.
Yeah.
And again, this is the problem the Fed is facing too. So this is the downside to bondholders. If you're investing in bonds right now, you have a problem.
Because it's going up, right?
$100 million worth of bonds, and you're going to try to sell them. You're going to get a discounted price if you try to unload bonds you currently hold in lieu of the new higher paying interest bonds that are coming out today. This is why it's very inappropriate, if you will, to hold a bond portfolio if you believe interest rates are rising. Now, the opposite is true if interest rates are going down.
Sure.
Because it means the bonds you bought last year are paying higher than the current ones. You might get a premium if you wanted to sell your bond even early than its due date.
Sure.
But if you try to liquidate a bond that's paying less than the current market environment, you're going to get a discounted price for it if anybody is willing to buy it at all. And that creates its own problem for bondholders. This is why a lot of people are looking for another place to park their capital. And I think that place should be in physical assets. I think people should be aggressively acquiring. I love gold and silver coins because of the fact that they're fixed in supply. Of all the physical assets that one can buy, there are lots of choices out there. But gold and silver coins make a wonderful tool because we already know they can never make any more of them. We know the date they stopped minting them. We know how many were produced. We know roughly what's left out there in the world. We know that there's existing demand for it, and that it's something that can be liquidated in small parts or large quantities at any given moment. So it's a perfectly fluid kind of market, but it creates a great place for people to store wealth during uncertain times. The one thing that we have figured out is that diversification was the most powerful tool that investors could have to make it through whatever economic environments were coming up. And the more uncertainty we have, the more important it is not to be too heavily weighted in any one area. And especially now when equities, and that would be stocks and bonds, are going to have a lot of trouble that they have not had the past few years. The opportunity is there to make money in other areas. And again, I believe people should be acquiring gold and silver coins to help not only diversify their wealth, but protect the value of the money that I think is going to be eroded quickly, because I don't believe this inflation problem is going away anytime soon.
So I think it's important to help our listeners understand that you are different from all of the commercials on radio and TV saying the world's coming to an end, you should buy gold. I mean, I hear them, right? They do this. But you've never been in that realm. You've never...
No, I've never bought that premise.
You've never bought that premise. You've always...
I can't accept the notion that the dollar would become worthless because I can't see how the world would function at all for a day without the dollar being around.
It's not going anywhere soon.
People don't recognize how much the dollar is used. You know, we can talk about all the fundamental problems with it, and they are real, and that is what creates that problem in people's mindset. Is it's hard to ignore the depth of the problems with the dollar. How do you ignore the fact that the government's 30+ trillion in debt, and interest payments alone on the debt are the second biggest item in its entire budget?
Is it $500 billion?
After the Department of Defense.
Is it about $500 billion on the debt? Something
a
like
year.
That? Yeah, a year.
So how do you ignore that? And how do you ignore the fact that we've added 40% to the supply of money in a 2-year period?
Wow.
You can't. But the idea that translates to the dollar becoming worthless, and that we're going to be bargaining on the streets to buy goods and services with things not U.S. dollars, you know, and people have said, well, how do I use my gold and silver coins? Am I going to the supermarket with a $20 gold coin to buy food? And I'm like, no. You're going to convert that back into money first, like it were a stock. Mm-hmm. You sell it, you get the value it represents. That value comes back to you in U.S. dollars. You spend those dollars. The idea being that storing your money in the gold and silver coin today at least prevents it from losing that buying power by the time you're ready to actually spend it.
Inflation, so I think there's a couple givens before we go that we should really understand that it's inflation. There's just no way, what you're saying, what I'm hearing you, that this inflation thing is going to tame down anytime soon. Mathematically, politically, economically.
Seems really unrealistic when the Fed says they think inflation is going back to 2% next year.
Yeah, not happening.
You know, I just find that a little hard to believe any more than I accepted the notion when they were saying it was transitory. I didn't buy that either, but they kept repeating it, and they kept saying
it's just transitory.
And I was struggling with this. Honestly, Patrick, I had a real hard time with it because, you know, it seemed to me it was so obvious that was not right or not true. That it left me with two possibilities. They were either that far removed from reality that they didn't understand basic economics, which I found troubling because this is the Federal Reserve, right? You know, these are brilliant people. They're well educated. They studied. This is what they do. How do they not understand that? That's not realistic.
They had to know.
And that left me with the other option, which is that they're just completely full of crap and that they're just trying to promote this particular, you know, mindset to stave off a bigger problem.
Right,
so I believe it was the latter.
Yeah. Another thing I wanted to ask before we go, too, you said something about if Russia really gets into a bad hair day and they can't pay on their Russian bonds that people have purchased in dollars and they would default, you had said something like, I mean, what would happen? And what could the United States do, or what could the Fed do, or what could anybody do? What are you going to do?
Well, there's two parts of that. So one, there's the who is the holder of that debt.
Right.
So let's say, you know, the European Central Bank has, you know, a bond that it's sold to Russia that is now due. Mm-hmm. And Russia says, well, we don't have the money to pay you. The EU may turn to the U.S. and say, look, would you release some of these sanctions against Russia so that we can get paid? You know, or do they take the position and say, we'll suck up the loss for the benefit of this putting pressure on Russia and adding these sanctions, you know, for the benefit of Ukraine? It's going to become an interesting problem. I think the pressure will build. I mean, it's sort of like, you know, how far will your friends support you?
Right.
At some point, they may turn around and go, oh, yeah, enough's enough. We want to get paid. So, yeah, we get that Russia's being bad and, you know, they need to be punished, but I still want my money.
So would you ever see the day where Russia would sell some of their gold to get enough dollars to keep?
Oh, hell yes. They may have no choice.
Really?
Like I said, they had a scramble. This morning, they were within,
I didn't see that story.
Days
really? Wow.
Of default. About $650 million was due today in U.S. dollars. And they had to dig through their pile because they do have a stockpile of U.S. dollars, which they will burn through in no time if they are forced to make payments in bonds in U.S. dollars. So they're doing a lot of things to try to get people to look at the ruble more seriously. I heard stories of the Russians' finance minister suggesting that they're going to try to back the ruble with gold or commodities. They're discussing all sorts of options, again, to try to put out the perception that, it's okay to take money in rubles. I would not do that were I a bondholder. I would not want to be paid in rubles because I would have a hard time accepting the notion that there's any stability in the value of a ruble in these circumstances.
I read they want to do something with the ruble or to tie it to a basket of currencies and maybe SDR and some gold and commodities.
Well, they have to explore all sorts of options because
get creative, right?
They need to try to convince you, for example, why would you want to hold rubles, right? So I'm going to try to sell you on the idea that you should be holding rubles. Well, how do I do that? Under the current environment, you might be very suspicious about the idea that the ruble is going to retain its value because it's all predicated on Russia's continued ability to keep selling its oil. Which, again, shouldn't be a problem, which is why the ruble's been able to even sustain itself under the last few months and all the sanctions. It hasn't really dropped a lot. Whatever dropped, it's come back already. But the question goes forward, how do we get people to perpetually want rubles? If the ruble looks weak because the economic environment is weak, you got to start coming up with other ways to attract people. And one of those might be, can you create a basket of goods and services or commodities against that now?
That's what they're trying to do.
Ruble, and then offer it to people and say, well, at least it's backed by something, and you'll feel better about that. But that's going to be a challenge.
And the difference between backed and exchangeable is huge, right? You're not going to be able to exchange a ruble for some gas or oil.
Yeah, they're not saying that.
No, they're not saying that.
They're not going that far.
Just be backed. As Andrew used to say, the dollar is backed by F-16s. Remember? He used to say, what's backing the dollar? Oh, F-16s are backing the dollar. God,
it's the good faith and credit of the United States government. So how good is the good faith and credit of the Russian government, to sustain the value of the ruble? It's a challenge for them.
And especially with every media outlet in the world and the so-called alternative media saying that Putin is the next Hitler, and he just is. He doesn't have a very good reputation right now, and whether or not it's valid, that's up to you to decide. But everybody's just kicking his butt. Just every.
And how much do people care? So, will a foreign country that wants to buy cheap oil from Russia really care that he's a bad guy?
No.
There's going to be a point at which they care, but there's going to be a point at which the money is going to outweigh their concerns. So, it's going to be a question of how bad of an actor he turns out to be and how perpetually he continues to be obnoxious to the world, and whether they deem that more important than getting paid.
Yes, sir.
But I see it somewhat problematic.
Here's an email from Karen. Patrick had a constitutional authority on yesterday, Richard Proctor. Oh, yeah, I'm glad she brought this up. And he mentioned that the spread between gold and silver is usually 1-16. Does Fred agree with that? And that goes way back? He talked. Is there something to that?
That up from time to time.
Is there something to
I've
that?
I've never found that relationship.
Or
means
isn't
a
it
lot.
supposed to be? Isn't it supposed to be 1-16? No, whatever that means.
If you want to go back historically, we're talking about $1 to $20. So, roughly 18-1 or so.
Right.
But again, I just have never really seen that relationship really held up per se. Sometimes that gap gets a little wider and then it closes itself. But, I do recognize that was there initially. Obviously, that doesn't really matter on a constitutional basis anymore. We don't utilize that.
We don't use it.
But, I've always looked at that. Once in a while, I'll pay attention to it if the gap suddenly seems to get really, really different. If it's 25-1 or 30-1 or 80, if it starts looking a little wider than normal, sometimes that tends me to lead toward thinking, well, maybe the gold's overpriced or the silver's underpriced. And usually within short order, they seem to kind of come back to that level. But I don't know that it really means much.
I just did the math now. It's 84. 84.
Yeah, it's usually like 80-1.
80-1. Boy, 16 would be big time silver. So when's silver going to really have a heyday? Boy, the silver monsters have been out there waiting for years. Forever.
Yeah, well,
right?
Again,
Wow.
As long as there's push against the markets to try to keep the prices from really escalating,
Yes.
it will still continue to climb under that pressure. But, I've always looked at gold and silver as a warning sign. And when they're running high, it's a flat out warning to people that there's a problem with the dollar. And it's the last thing that those powers that be want to see. They don't want the public to recognize the flaw, which is why they have a real problem with inflation. It's one thing when you're printing money and nobody sees the result of it, you can get away with that for a while because the public isn't screaming. But when you anecdotally cannot walk through the day-to-day life without experiencing the inflationary problem, this is why it's getting so much press now.
Hey,
the president's talking about it. Congress is talking about it.
Even with the Prius, $4 a gallon's not fun, man. Even with the Prius, you know what I'm saying? It's like, come on, what's up with
electricity costs? Everything's going up.
What's up with that?
It's across the board. But those are the problems that get much more attention.
Yeah,
because everyone experiences this in their day-to-day life, and that means that you can't hide from it anymore. And that's why it's become a problem.
Oh, I tell you
that's
what.
why the Fed is trying to address it.
And you know how many trucks we have in Texas, and those babies aren't getting 40 miles a gallon like I am. So that there's not a lot of happy campers out there driving around in trucks, getting 15 miles a gallon or 20 miles a gallon. Not good, That's not. Well, here we are. Oil is going up to $106 today. So,
yeah, WTI is back over 100 and 101.
106.
106. Okay, so it's skyrocketing.
Yeah, it's moving up today. And well, kiddo, here we are. So, talk a bit about your company, and I'm going to put your slide up here. And why would folks want to call you and do something fun with gold and silver coins? And how do they do that?
Yeah, it is fun. But I think the most fundamental reason that we're getting a lot of people that are doing this now, and I think a lot of people should be doing this now, is that there are two things. One is this economic uncertainty. And during uncertain times, nothing weathers the test of time better than gold and silver. Nothing. It has held up for thousands of years as a store of value, and for a very good reason. And the gold and silver coin market is thriving as long as we continue to print unbacked money in the United States, which I believe is going to continue for the rest of at least my life. I don't see that changing anytime soon. We're going to continually inflate the value of paper money. So for those that are looking to store wealth for their future, you need some physical, tangible assets. And with us, you get actual physical delivery of the physical gold and silver. You get the actual product. And we'll help educate people on how to do this properly, the particular kind of gold and silver coins that are best, and then again, help guidance-wise and make sure that we provide you the best possible product for you. But again, I think in an uncertain economic environment, you've got to diversify. In an inflationary environment, it's critical to sustain buying power that you don't have too much money in paper that's being heavily inflated. You should be acquiring gold and silver coins, and on these price dips, what a great buying opportunity for people that might be new to the market or have larger amounts of capital that they're looking to move into the economy. This would be the time to do it.
And you all, with your whole staff, are all well informed and know that you really caution people to not just buy a $20 gold piece or something with the hopes of selling it in a year, right? To when the price of gold goes up. These are longer term investments, right? You try to inform people.
Yeah, this is something, again, inflation isn't going to erode the value of your money overnight. It's something that takes hold over time. So that what we're looking at is the ability to sustain value in money going forward. And I usually recommend about a 5-year time frame that people should consider their hold period for physical assets so that they can allow the inflation to do what it's going to do and grow the value of the gold and silver coins they've purchased in the past. Those that purchased in 2020 and 2021, they've seen some pretty good gains already. And that is a little more unusual, but that's the economy we're in where things are happening a little more quickly. But again, I do caution short-term investors or those that are speculating that the end of the world is happening next week. And, I can't tell you the thousands of calls we've had from people who some event was going to happen within a short period of time that they thought was going to unravel everything. And that's why they wanted to buy gold and silver.
Y2K, remember that?
I don't think that's the way to do this. I think it's a longer-term investment for those people that are thinking ahead and just saying, look, I just don't want to have money that I've worked hard to save and earn change in value because of things I can't control.
Yeah.
We can't control how much the government is going to deficit spend. We cannot control the fact that we have an unbacked currency in America. We can't control the fact government's already $32 trillion in debt. But what we can do is diversify our own assets. So protect your own personal wealth, accumulate physical gold and silver coins. I've got some great deals on some gold packages.
Cool.
For any of the listeners that want to give us a call, just mention you heard us on One Radio Network. And we've got a couple of great deals going this week. So give us a call.
And what do you have in the way, before we go, of currency silver? In other words, not the coins in the plastic cases and graded.
Actually,
What do you
much
do?
better now than we were a month ago. We were having some serious shortage problems with, half dollars and things from time. Right now, we're pretty steady. So I have available bag quantities and smaller amounts. A bag referring to 1,000 face value. So a bag of dimes is 10,000 dimes. A bag of quarters is 4,000 quarters. A bag of halves, 2,000 half dollars. I have quite a decent amount now of inventory available in all of those denominations, which has been a bit of a struggle. So this would be a good opportunity to take advantage of that as well.
And so people will just buy a bag of 4,000 quarters, which is about how much silver in each quarter, Fred? How much silver?
Oh, it runs price-wise around $25,000, $27,000 or so, depending on the price of silver that given day. And it's about 52 pounds of silver. It's a good quantity.
Wow.
It's a great way to store value, because you can sell 1 quarter at a time. You can use 1 quarter at a time to buy goods and services, or you can sell the whole bag all at once.
Yeah. And that's kind of fun, especially if you're a crashaholic and you think that we're going to be running around the streets naked in tumbleweeds. Currency silver would be fun to have.
Sure.
Yeah. Anyway, we take care of everybody around here. All right, Freddie. Well, thanks for calling on. Say hi to Donna, Roger, and on the rest of the staff. And we will see you.
Will do.
We will see you next, the first Wednesday in
on our next episode.
June. Wow. Is that crazy? That's crazy. June. Kid, thanks a lot. 800-878-2646, Fred Dashevsky. Thanks, Fred. Take care of yourself. See you soon.
Thank you, Patrick.
Bye-bye.
Great to see you.
And nice to see you.